Hi, welcome back to the Seller Finance Center. Today I want to talk to you about the power of interest and how you as the seller can use seller financing to take on the role of the bank. And how do banks make money? Banks make money by charging interest. And so using seller financing is a great way to create monthly income for yourself and to create long-term wealth. So today we'll cover the basics around what is interest, how do banks make money, the power of interest over time, and how to use seller financing to make money like a bank. So what is interest? Very simply, interest is the cost of using somebody else's money. When you borrow money, you pay interest. When you lend money, you earn interest. So let's discuss this in a little bit more detail. So how do banks make money? Well, whether you know it or not, when you deposit money into your bank account, you're giving your bank permission to use your money to make loans. So don't panic. The banks have reserves. They're required to keep a certain amount of reserves. There's insurance for the banks. Your deposits are safe. So don't worry about this if you didn't know it. I will say 100 years ago, this could be a problem. There were times where the depositors maybe lost confidence in the bank and said, hey, I want all my money back. But they had lent all that money to other people and they couldn't pay back their depositors and there would be a run on the bank. It doesn't happen anymore, so please don't worry. But whether you know it or not, your bank is using your money to make loans out to others. And when they loan money out to others, it's at a certain cost. So the cost of the borrowing the money is interest. So think about mortgages, student loans, car loans, credit cards, all of these places where you've pulled money, the bank has loaned you money, and you're paying them interest. That's basically the cost of using the bank's money. And that bank's money comes from deposits. The bank collects money off that interest paid by borrowers, and then they do give a small amount of that back to you. Interest rates on deposits are very low these days, maybe 1%. But they're loaning money out at 5% for mortgages, 3% for student loans, 10% for credit cards, right? So they're making a lot more money on the interest on the loans than they have to pay you, the depositor, for using your money. And that difference or spread between the interest being charged to borrowers and the interest being paid on deposits is called net interest margin. And this is a key concept around how you can make money at seller financing. So let's go through a very specific example around how banks make money. So step one, there are bank deposit customers like you and me who have checking accounts and savings accounts with Bank of America, Chase, Citi, whoever. Let's say we all have an average of $10,000 in our accounts, okay? That bank then takes all of those deposits and uses them to loan out money to borrowers for mortgages, for car loans, maybe they're lending to commercial entities. And so that's where the money goes out. So once the money has gone out to borrowers, they begin paying monthly interest back to the bank. So I'm using an example here of that the borrowers are paying 6% annualized interest for the right to borrow that money, and they pay that back to the bank. Now that bank, again, pays you a nominal interest rate on your deposits, so call it 1%. Okay, so you can quickly see, they're getting paid more interest on the money they're lending than they're paying me, the depositor, on the money that I've deposited. How does that work? Well, you've just understood the way banks make money. So to put this into an analytical math equation, okay, if the bank has $1 million of deposits, okay, and they're paying you 1% interest, they're paying all of their depositors 1% interest, they're going to be paying out roughly $10,000 a year in interest. But on their loans, if they've loaned out that $1 million and they're charging 6% interest, they're going to be getting $60,000 back on an annualized basis on the loans they make. And so the difference between the $60,000 they bring in from interest as interest income and the $10,000 they're paying out to people like us as interest expense is what's called net interest margin, and that's $50,000. So I'm using a very small example of $1 million. Most banks have holdings in the billions. So you can quickly do the math and see just how much money banks can make by charging interest. So let's take that concept around the power of interest and use it in a seller financing example. So when you sell your home for cash, so let's say you're trying to sell your home for $150,000. So you get your sales price, you have to pay realtor's fees and closing costs and other things. And so let's say that's $10,000. And so you'll pocket at the closing, again, assuming you own the home free and clear. Okay, so there's no underlying mortgage in this example. You'll walk away at the closing with $140,000. Now, my experience is unless you're trying to get into another home, so you're using that cash as a down payment on a new home, generally, my experience is that $140,000 doesn't get invested. Maybe it makes a couple of percent interest at a bank, or it gets spent on a new car or something else. So in this example, I'm not assuming that gets reinvested at some kind of high interest rate. Now, when you sell your home with seller financing, let's assume you sell it at the same sales price. Now, I'll say, when you sell a home with seller financing, you almost always get a higher sales price than what you will get when you sell it conventionally. Because seller financing buyers are less interested in getting the best sales price or purchase price. They're much more interested in how much do they have to pay a month and how big a down payment are they going to have to pay. So you can generally charge more. I think every seller financed project we've ever done, we've sold the house, the sales price has been higher than the market for those homes being sold conventionally, okay? But let's assume you sell it for the same price. You get a $20,000 down payment, you have to pay those same realtor's fees and closing costs, and so you end up with $10,000 in your pocket. But in addition, you get a seller finance note from the buyer. So basically, you get an IOU from the buyer. It's like a mortgage, right? And assuming a certain amount of interest, I think I assume 6% interest in this example, you get 30 years of principal and interest payments. I added back the down payment. So instead of pocketing $140,000 on that $130,000 note over 30 years, you'll pocket $295,000, including the down payment. Okay? So that's 110% of what you would make if you just pocketed the money at closing. And the big difference is 30 years of interest on that $130,000 note is $145,000. So the interest is more than what you actually lent the buyer. So you can see just how powerful interest is. Again, $140,000 in your pocket or $295,000 in your pocket over the period of the seller finance note. And that is all about the power of interest. So you can make a lot more money selling your home if you act like the bank and collect that interest. So the key things I'd like you to take away from this power of interest discussion. The key to making money as a seller with seller financing is interest. When you offer seller financing, you are going to charge the buyer interest in return for you financing their purchase of your home. You will make significantly more money on the sale of your home over the period of the loan if you offer seller financing. And the two major benefits I want you to think about is one, you get this regular income stream. You get a check from the buyer every month. And when you add up all those checks, you get a much higher long-term return on all of that income than you would just by selling your home for cash. So I hope that was a helpful discussion around the power of interest, and we hope to see you at the Seller Finance Center soon.